Welcome to the Ultimate Beginner's Guide to Stock Options Trading. In this free video course, I'm going to show you the basics of stock options trading in a simple manner, which is extremely important because some educators tend to gloss over some important fundamental ideas, and that makes things confusing later on when more complex and necessary concepts are introduced. In a first moment, we are going to study what an option really is, how the options market works, the terms and definitions you need to be familiar with, and a few basic examples of how options are traded. In a second moment, we are going to study 51 different option strategies for beginners. You will learn how to build them, their ideal market scenario, risk structure, advantages, disadvantages, and dangers. In a third moment, I'm going to introduce a few more advanced ideas and how options are traded by professionals in the institutional trading world. We are going to study a little bit about the many variables that affect option prices, option pricing models, the real use of options in the institutional world, and how the retail trader like you and me can take advantage of the professional way of trading options like large banks do. So without further ado, let's begin the first part of the course, beginning by the definition of an option. An option is a derivative, which is a type of financial instrument that derives from another financial instrument. That means that the price of an option is partly dependent on the price of another financial instrument, which in this case is called the underlying asset. For example, the Tesla option is derived from the Tesla stock. When I say that the option is derived from the stock, I mean that part of the option price is a function of the stock price on which it is based. There are other variables involved in the option price, but before we take a look at these other variables, let's understand the definition of an option. Pay very close attention to this portion of the course because it is important for you to avoid being confused about the different types of market participants later on. An option is the right, but not the obligation of negotiating the underlying asset at a fixed price in the future. We need to unpack this statement into smaller pieces to understand a few different elements of an option. Here it's easy to understand why an option receives this name. It's the right but not the obligation of negotiating the underlying asset at a fixed price in the future. The right of doing something is not the obligation of doing something, and that means you have the option of exercising the contract or not at the expiration, depending on the market conditions at that time. To have this right of negotiating the underlying asset at a fixed price in the future, the trader needs to pay an option premium. This works very much like an insurance policy. You pay for the right of having coverage in the case of an accident. The option premium is a function of the option price and the option contract multiplier. The option price is how much each option is perceived to be valued by the market, and the option price in alignment with the option contract multiplier will give you the total option premium you're going to pay for the option contract. For example, if the option contract multiplier is 100 and the option price is $18, you are going to pay $1,800 of option premium. Each option in the contract containing 100 options gives you the right to negotiate one share of the underlying asset at a fixed price in the future. In summary, when you buy an option, you are buying a right. The right to negotiate the underlying asset at a fixed price in the future. This leads us to the second piece of the option definition, meaning that whether you will have the right to buy or the right to sell the underlying asset at a fixed price in the future depends on the type of option you buy. There are two types of option contracts. We have call options, which give you the right to buy the underlying asset at a fixed price in the future, and put options, which give you the right to sell the underlying asset at a fixed price in the future. This fixed price I keep referring to is called the strike price of an option. The strike price is the price you'll be able to negotiate the underlying asset at the expiration date, regardless of the market price at that time. For example, buying a call option with a strike of $100 gives you the right to buy the underlying asset at $100 per share in the future, regardless of the underlying stock price at the expiration. Buying a put option with strike of $320 gives you the right to sell the underlying asset at $320 per share in the future, regardless of the underlying stock price at the expiration. Notice once again that when you buy an option, you are buying the right to do something, but I will expand more on this in just a little bit. The last part of the statement that defines an option relates to the expiration. An option gives you the right but not the obligation of negotiating the underlying asset at a fixed price in the future. The expression "the future" relates to the expiration date of the option. This is where you will be able to exercise your right or not, depending on the situation. Here it's important to point out that there are mainly two types of options when it comes to the expiration date. We have European options, which can only be exercised at the expiration date, and we have American options, which can be exercised at any moment. Let's take a look at a few simple examples now, because that's the easiest way of learning how all these different elements of options work. Let's suppose you decide to buy options from a hypothetical company called Company A. The reason you might want to buy these options is another subject completely, so we'll leave it aside for now. Let's just focus on the mechanics of how options work for the moment. Let's imagine that you buy an European call option contract from Company A that is priced at $20 with an option contract multiplier of 100, totaling an option premium of $2,000, a strike price of $1,000, and it is 30 days away from the expiration. The current stock price from Company A is $1,000. Since we are buying a European call option, that means we are buying the right to buy the underlying stock at the expiration date, which is 30 days away, at a fixed price of $1,000, which is the strike price of this call option. In other words, if we buy one call option contract in this configuration, we will have the right to buy 100 shares of the underlying stock at $1,000 per share at the expiration date, regardless of the underlying stock price at that time. The option premium of $2,000 means that we are paying $2,000 to have the right to buy 100 shares of the underlying stock at $1,000 per share at the expiration date, since this is a European call option contract. Now let's imagine that we fast forward to the expiration date 30 days later, and the underlying stock price is at $1,200. This is where you begin to understand the real value of option contracts. With this call option, you acquire the right to buy 100 shares of the underlying stock at a fixed price of $1,000 per share, but at the expiration date, the underlying stock price increased to $1,200. That means you can exercise the option contract and buy 100 shares of the underlying stock price at $1,000, totaling a $100,000 position, and immediately sell these 100 shares at the current market price of $1,200, totaling a $120,000 position. Your gross profit will be the amount you sold minus the amount you bought. Your net profit will be the gross profit minus the option premium you paid for having the right to buy the underlying stock at $1,000 per share at the expiration. In real scenarios, you will also have the transaction costs, of course. In the case of the call option contract, it makes sense to exercise the option because the underlying stock price went above the strike price of the option at the expiration date. That's where the profit is coming from. However, if the underlying stock price was below the strike price of the call option at the expiration, it would not make sense to exercise the option, because then you would have to buy 100 shares at a higher price and then immediately sell at market for a lower price, therefore generating a loss. In this case, the better choice is to not exercise the option and only pay for the premium, which you have to pay anyway. The value of having an option contract is that you limit the amount of risk in the case you are wrong about the future market direction. Let's quickly analyze a payoff chart to see the benefit of having a call option contract in this particular situation. In this chart, we have the underlying stock price at the expiration date in the x-axis and the net profit in the y-axis. Notice that when the underlying stock is at $1,000 and below, it doesn't make sense to exercise the option, so the maximum loss is limited to the option premium paid. However, the more the underlying stock rises above the strike price of the call option, the higher the profit. In this chart, it becomes clear that the advantage of having a call option in this situation is that it caps the maximum potential loss to the option premium, and the maximum potential profit is unlimited. and attached to how much the underlying stock price rises above the strike price of the call option. It all comes down to the choice that you have at the expiration of exercising the option contract or not. If you can generate a profit by exercising the contract, then it makes sense to exercise the contract. If exercising the contract generates a loss, you can choose not to exercise it and only lose the option premium, which is the cost of having this right at the expiration date. In summary, an option contract is all about having the option of exercising the right to negotiate the underlying asset in the future if it makes sense to do so. Let's now assume the same parameters, but instead of a European call option, we'll use the example of a European put option, which will give you the right to sell the underlying asset at a fixed price in the future. Assuming the same parameters, we have one put option contract priced at $20 per option, an option contract multiplier of 100, totaling an option premium of $2,000, a strike price of $1,000, 30 days away from expiration, with the current underlying stock price at $1,000. When the expiration date comes 30 days later, the underlying stock price is $1,200. If we exercise the put option, we will sell the underlying at $1,000 per share and buy at $1,200 per share, which will of course generate a loss because we will be buying high and selling low. In other words, exercising the option doesn't make sense, so we choose not to, and our loss is limited to the option premium. If the underlying stock price went below the strike price of the put option at the expiration, it would make sense to exercise the put option, but that was not the case. This is the payoff chart of the put option contract. For values above 1,000 in the underlying stock price at expiration, it doesn't make sense to exercise the put option, so the loss is limited to the option premium. For values below the $1,000 mark, it makes sense to exercise the put option. From these two situations, we can notice that depending on where the underlying price is in relation to the option strike at the expiration, the option can be valuable or worthless. This leads us to the concept of moneyness of an option. When it makes sense to exercise an option because that will generate a profit, it's said that the option has intrinsic value. In the case of call options, the option will have intrinsic value when the underlying stock price is above the strike price of the option. In the case of put options, the option will have intrinsic value when the underlying stock price is below the strike price of the option. An option can have three moneyness definitions, which relates to the underlying stock price and the strike price of the option. If an option contract has intrinsic value, it's classified as an in-the-money option. If the underlying stock price is the same as the strike price, the option is classified as at the money. If the option has no intrinsic value, the option is classified as out of the money. Let's first see how these terms and definitions work with call options. A call option contract gives you the right but not the obligation to buy the underlying stock at a fixed price in the future, so the option will only have intrinsic value if the underlying stock price is above the strike price of the option. In other words, the call option contract only becomes in the money if the underlying stock price goes above the strike price. We summarize this rule with a simple formula. Considering that S is the underlying stock price and K is the strike price of the call option, if S is greater than K, the call option contract has intrinsic value, therefore it's in the money. If S is equal to K, the option contract is at the money. If S is lower than K, the call option contract is out of the money. With put options, we are dealing with the right but not the obligation to sell the underlying stock at a fixed price in the future. Therefore, the put option contract will have intrinsic value if the underlying stock price is below the strike price of the option. For example, if you have a put option with strike of $100 and the underlying stock price is at $80 at the expiration, you can buy the underlying stock at $80 and sell it at $100 for a profit of $20 per share. In other words, if S is lower than K, the put option contract is in the money. If S is equal to K, the put option has no intrinsic value and is considered to be at the money. If S is greater than K, the put option is considered to be out of the money. So far, we've seen what happens when you buy an option contract. The purchase of an option contract means you are buying a right to negotiate the underlying stock at a fixed price in the future. However, if you are buying an option contract, there must be someone else on the other end of the transaction. This leads us to the fact that there are 4 types of participants in the options market. We have call option buyers, call option sellers, put option buyers, and put option sellers. The options market is different than the spot market because one side of the market has a right, so it necessarily follows that the counterpart has an obligation. In other words, there is an asymmetry between option buyers and option sellers. Let's take a simpler example of the call option contract first and analyze the payoff charts of both call option buyers and call option sellers to observe an important distinction between the two. As we saw earlier, the call option buyer has a risk that is limited to the option premium. If the call option is below the strike price at the expiration date, the trader will not exercise the option, and his loss will be equal to the option premium. In other words, if the call option buyer loses the option premium, it means that the call option seller wins the option premium. We can see in the call option seller payoff chart that if the underlying stock price is below the strike at the expiration, the call option seller will have a profit equal to the option premium. However, and this is the important part, if the call option becomes in the money at the expiration date, meaning that the underlying stock price is above the strike, it makes sense for the call option buyer to exercise the option. And in this case, the call option seller is obligated to sell the underlying stock at the strike price, regardless of the current underlying price. That means that the call option buyer has an unlimited potential profit, and the call option seller has an unlimited potential loss. The difference in the risk structure between being a call option buyer and a call option seller is enormous. The call option buyer has a limited risk and an infinite potential reward, while the call option seller has an infinite potential risk and a limited reward. Another way of looking at this is that the reward to risk ratio of call option buyers is very good, and the reward to risk ratio of call option sellers is very bad. Buying options provide a good risk structure, while selling options provide a terrible risk structure. With put options, the risk structure is similar, but with subtle differences. Put option buyers have a small risk that is limited to the option premium and a large potential reward instead of an infinite potential reward like the call option buyers. That happens because there is a limit to how much a stock can fall. It can never go below 0, but there is no limit to how much a stock can rise. Either way, the risk structure of put option and call option buyers is very similar. Put option sellers, on the other hand, have a limited reward and a large potential risk. Just like with call options, with put options, being on the buy side represents a small risk with a large potential reward, and being on the sell side represents a large potential risk with a small limited reward. This concludes the first part of the course, so now we are ready to move on to the second part, where we are going to learn about many different speculative options trading strategies. Before we begin, it's important to point out that these strategies will be analyzed assuming they will be carried to the expiration of the options involved. We must do this in the first moment for simplicity's sake. Carrying such strategies to the expiration is not a necessity though, but if the trader wants to speculate with these strategies without carrying them to expiration, he or she must become aware of further details like option pricing models and option Greeks, which are more advanced subjects. Since this is a beginner's course, we'll focus on the simpler aspects first. In the strategies, I'm assuming an option contract multiplier of 100. All the options have the same expiration date. You should also be aware that the P&L, strike price, and underlying prices being used in this presentation are all hypothetical, and they will vary a lot depending on the option. It's also important to recall that this video is made for educational purposes only. I am not suggesting or recommending in any way that you trade these strategies. Trade at your own risk. With that said, let's begin the second part of the course by looking at the most basic options trading strategies you can make, assuming you are going to use options to speculate about future price direction. We'll divide these strategies into 5 categories. We'll begin with the most basic strategies, then we'll move forward to the straddles, strangles, and guts, then the butterflies and condors, then the vertical spreads, ladders, and ratio spreads, and at last, the synthetic strategies and a few others. We'll learn how to build the strategies, the payoff chart and its peculiarities, the ideal market scenario for each strategy, and the risk structure of each strategy, which is an incredibly important thing to pay attention to, as it will determine if the strategy is safe for long-term application or not. So without further ado, let's begin with the basic category. The first strategy within the basic category is the long call, which simply consists in buying an X number of at-the-money call option contracts. As we have seen previously, this is the payoff chart of a long call. The inflection point between the two lines is marked by the strike price of the option, and since we are dealing with an at-the-money call option, this is where the underlying price will be when you build the strategy. The long call strategy is ideal if the trader believes that the underlying stock price will be above the strike price at the expiration date. In other words, the trader hopes that the call option becomes in the money at the expiration. So the long call option is ideal for traders with a strong bullish bias. In terms of the risk structure, the long call strategy provides a limited risk, which is limited to the option premium, and an infinite maximum potential reward, because there is no limit to how much the underlying stock price can rise. The more the stock price rises above the strike price, the higher the profit. In the case that the trader is wrong about his directional bias, the long call strategy provides a limited risk no matter how much the underlying stock price drops below the strike. The maximum potential reward is unlimited, and the maximum potential loss is limited, which makes the long call strategy a safer strategy in terms of risk structure. Next in line, we have the short call strategy, which consists in selling an X number of at-the-money call option contracts. We have already observed the payoff chart of shorting a call option previously. The inflection point between the two straight lines is determined by the strike price of the call option contract. In the strategy, the trader makes money if the underlying stock price is below the strike price at expiration. In other words, this is a strategy for those who have a bearish bias. One interesting thing here is that it doesn't matter how much the underlying stock price goes below the strike price at expiration, because the payoff is constant as long as the underlying price is below the strike at expiration. So you can make money with this strategy even by being slightly bearish. However, if the underlying price goes above the strike price at expiration, a loss will occur, and this loss is attached to how much the underlying price goes above the strike. In terms of the risk structure, this strategy provides a limited maximum reward and an infinite potential risk, so it has a dangerous risk structure. As it was stated a few times before, selling options is not a good idea because of the limited potential reward and the infinite potential risk. Next in the basic option strategies, we have the long put strategy, which consists in buying an X number of at-the-money put option contracts. In the payoff chart of a long put strategy, we can see that it is the mirror image of a long call strategy, meaning that the strategy becomes profitable if the underlying price goes below the strike price at the expiration. If the underlying goes above the strike at expiration, the loss is limited to the option premium. This is a strategy for those who have a strong bearish bias, as the trader hopes that the put option becomes in the money. In terms of the risk structure, the situation is similar to the long call, but not quite the same. The maximum profit is very large, but it doesn't tend to infinity. That's because there is a limit to how much the underlying stock can fall, which is how a put option contract becomes in the money. That's not the case with call options, since there is no limit to how much the underlying can rise. Regardless of this difference, the long put is a good strategy for a strong bearish market bias because it provides a limited maximum risk and a large maximum reward. Since the long put provides a limited maximum risk and a large maximum potential reward, it's considered to be a safer strategy in terms of risk. Next, we have the short put strategy, which is a mirror image of the short call strategy in terms of payoff. The strategy consists in selling an X amount of at-the-money put option contracts. In the payoff chart, we can see that the inflection point is determined by the strike price of the put option being sold. If price rises above the strike price, profit is limited by the option premium. If price falls below the strike price, The loss is proportional to how much the stock falls below the strike level. Contrary to the short call, the maximum risk is not infinite, but it's very large compared to the maximum reward. So the reward to risk ratio is very small, which renders this strategy as poor in terms of risk. The short put is a bullish strategy, and one of its advantages is that the profit is the same no matter how much the underlying stock rises above the strike. However, the risk structure is unfavorable and dangerous. Next, we have a strategy called covered call, which consists in buying 100x shares of the underlying stock and selling X number of at-the-money call option contracts. This is exactly the same as the short put strategy in terms of payoff, but it's a different way of building the strategy without any put options. In the payoff chart, we can observe that this strategy is exactly the same as the short put. So the ideal market scenario here is price rising above the strike price. The risk structure is also the same as the short put. So the maximum reward is limited and the maximum risk is limited but very large compared to the maximum reward. Just like in the short put strategy, a large maximum risk and a small maximum reward renders this strategy as dangerous. The last of the basic strategies we are going to study is called protective put, and it consists in buying 100x shares of the underlying and buying an X number of at-the-money put option contracts. In terms of payoff, this is exactly the same as the long call strategy, but it's a different way of building the strategy without using call options. Instead, a combination of the underlying stock and put option contracts is used to create the same payoff that a call option would generate. The ideal market scenario here is bullish, so it's interesting that the underlying stock price rises as much as possible above the strike price of the option being used in the strategy. In terms of risk, the protective put strategy provides a limited risk and an infinite maximum reward because there is no limit to how much the underlying stock price can rise. The more the stock price rises above the strike price, the higher the profit. In the case that the trader is wrong about his directional bias, the protective put strategy provides a limited risk no matter how much the underlying stock price drops below the strike, so the protective put strategy has a safer risk structure. Let's now move on to the second category of option strategies, which is composed by the straddles, strangles, and guts. The first strategy we'll study in this category is called long straddle, and it consists in buying X number of at-the-money call option contracts and buying X number of at-the-money put option contracts. Both options must have the same strike price. In the payoff chart, we can see that the P&L forms a V-shape, meaning that the trader can profit in both market directions. The ideal market scenario for the long straddle strategy is that the underlying price moves as far away as possible from the strike price of the options being used in either direction. As we can see in the payoff chart, if the underlying doesn't move away too much from the strike at expiration, the P&L line will be within the range of prices that produce a loss. The risk structure of the strategy is quite interesting because the risk is limited to the sum of the option premiums paid for the long call and long put, but the maximum profit is unlimited, and it's proportional to how much the underlying price moves away from the strikes at the expiration. Another way of thinking about this is that the long straddle is a bet on market volatility. In other words, the trader believes that the volatility in the underlying asset will be enough to push the price far away from the strike price. The interesting thing is that you don't need to have a directional bias because you can profit in either direction. You just need a lot of volatility. Because of the limited risk and the infinite potential reward, the long straddle is considered to be a safer strategy. Next, we have a similar strategy called long strangle, which consists in buying X number of out-of-the-money put option contracts and buying X number of out-of-the-money call option contracts. In the payoff chart, we can see the similarity with the long straddle strategy. The difference between the long straddle and the long strangle is that the maximum total risk is capped, and therefore lower in a long strangle. However, the price range out of which the underlying price has to escape is larger. Just like in the long straddle, the long strangle is a bet on high volatility for either side. In terms of risk, it's very similar to the long straddle, where the maximum total risk is limited to the sum of the option premiums. The maximum total reward is large for the downside and infinite to the upside. This is a relatively safe strategy due to the limited total risk, the bet on volatility, and the infinite maximum reward. The long gut strategy is very much the same as the long strangle, but instead of buying out of the money call and put options, we buy in the money call and put options of different strikes. The payoff is very similar to the long strangle, and the risk profile is also very similar. The main difference is in the way of building the strategy with the in-the-money options instead of out-of-the-money options, like in the long strangle. The long straddle, long strangle, and long gut strategies are all bets on market volatility. These strategies become profitable if the underlying price is far away from this price range determined by the option strikes when the strategies are built. The next three strategies are the short version of these three strategies we just saw, and rather intuitively, the short version is a bet against volatility. The short straddle strategy consists in selling X number of at-the-money call option contracts and selling X number of at-the-money put option contracts. In terms of payoff, this is the mirror image of the long straddle strategy because the maximum profit occurs if the underlying price is exactly at the strike price when options expire. The more the underlying price moves away from the strike price of the options, the lower the profit. This is why the short straddle is a bet against volatility. The ideal market scenario is that price remains the same without volatility. In terms of risk, the strategy provides a limited maximum profit that is equal to the sum of option premiums and a large maximum risk for the downside and infinite maximum risk for the upside. And it's a bet against volatility, so it's a high-risk strategy. Very much like the short straddle is the mirror image of the long straddle in terms of payoff, the short strangle is the mirror image of the long strangle. This strategy consists in selling X number of out-of-the-money put option contracts and selling an X number of out-of-the-money call option contracts. In terms of payoff, the short strangle is the mirror image of the long strangle, so the payoff is capped by the two vertices created by different strikes. The strategy reaches its maximum profit if the underlying stays within the range determined by the two out-of-the-money strikes. Losses occur when the underlying price moves away from this range in either direction. The ideal scenario here is that price remains calm and within the specific range, so it's neither bullish nor bearish. It's a bet against volatility. In terms of risk, the short strangle provides a limited maximum reward and a large maximum risk for the downside and infinite maximum risk to the upside, and it's a bet against volatility, so it's a high-risk strategy. The short gut strategy is very similar to the short strangle, but instead of selling out-of-the-money options, the strategy consists in selling X number of in-the-money call option contracts and selling X number of in-the-money put option contracts. In terms of payoff, the short guts works exactly like the short strangle. The maximum profit is determined by the range between the strike prices used to form the strategy. Losses occur when the underlying price goes far away from the strike prices in either direction. Ideally, the trader wants the underlying price to stay within the range determined by the strike prices. In terms of risk, there is a limited maximum reward and an infinite maximum risk. The short guts, like the short strangle and the short straddle, it's a bet against volatility, and therefore a high-risk strategy. Let's now move on to the third category, which is composed by the butterflies and condor strategies. The long call butterfly is a strategy formed by three legs. To form this strategy, you will sell 2x number of at-the-money call option contracts, buy X number of an out-of-the-money call option contract, and buy X amount of an in-the-money call option contract. In terms of payoff, this strategy is similar to the short straddle in the sense that it is a bet against volatility, but there is an important difference, which is that in the long call butterfly, the maximum potential loss is limited. The highest reward occurs if the underlying price doesn't move away from the at-the-money option strike. In terms of risk, because of the fact that this is a bet against volatility, but with a limited risk, the long call butterfly is a moderate risk strategy. It's safer than a short straddle, for example, where there is no risk limit. The long put butterfly is exactly the same as the long call butterfly, but the strategy is formed only by put option contracts. To form this strategy, you will sell 2x number of at-the-money put option contracts, buy X number of an out-of-the-money put option contract, and buy X number of an in-the-money put option contract. In terms of payoff, this strategy is similar to the short straddle in the sense that it is a bet against volatility, but there is an important difference, which is that in the long put butterfly, the maximum potential loss is limited. The highest reward occurs if the underlying price doesn't move away from the at-the-money option strike. In terms of risk, because of the fact that this is a bet against volatility, but with a limited risk, the long put butterfly is a moderate risk strategy. It's safer than a short straddle, for example, where there is no risk limit. Next, we have a strategy called iron butterfly, which is a combination of 4 different legs. To form an iron butterfly, the trader must buy an X number of out-of-the-money put option contracts, sell an X number of at-the-money put option contracts, sell an X number of at-the-money call option contracts, and buy an X number of out-of-the-money call option contracts. Once again, the payoff is very similar to the long call butterfly and the long put butterfly. The difference lies in the way the strategy is built. The long call butterfly is built only with call options, the long put butterfly is built only with put options, and the iron butterfly is built with a combination of calls and puts. The ideal scenario, just like in the previous 2 strategies, is that the underlying price doesn't move away from the at-the-money strikes. In terms of risk, the iron butterfly is similar to the long call butterfly and the long put butterfly in the sense that it is a bet against volatility with limited risk, so it's a moderate risk strategy. The next strategy we'll study is called long call condor, and it's built by buying an X amount of in-the-money call option contracts, shorting an X amount of less in-the-money call option contracts, shorting an X amount of out-of-the-money call option contracts, and buying an X amount of more out-of-the-money call options contracts. In terms of payoff, the condor is very similar to a butterfly, but the difference is that the range of price that maximizes the potential reward is wider, and it's determined by the strikes of the call option contracts being shorted. You can think of the long call condor as a short strangle, but with limited maximum risk. In terms of risk, the long call condor provides a maximum potential reward that is more or less similar to the maximum potential risk. This happens as a trade-off because the condor widens the range of price that will maximize the reward. This strategy allows you to choose a price range for the underlying price to be at expiration. If the underlying price is within this range at expiration, you will get the maximum reward. Like the long butterflies, the long call condor is a bet against volatility with limited maximum reward and limited maximum risk, so it's a moderate risk strategy. Next we have the long put condor strategy, which is exactly the same as a long call condor, but is built using put option contracts instead of call option contracts. The long put condor involves buying an X amount of out-of-the-money put option contracts, then selling an X amount of slightly less out-of-the-money put option contracts, selling an X amount of in-the-money put option contracts, and then buying an X amount of deeper into the money put option contracts. The long put condor has exactly the same payoff and risk structure of a long call condor. The only difference lies in the fact that this strategy is entirely built using put option contracts. In other words, it's a bet against volatility with limited risk. Ideally, the trader wants the underlying price to stay within the range determined by the inner strikes. Next in line, we have a strategy called iron condor, which is built using a combination of call and put option contracts. The strategy consists in buying an X amount of out-of-the-money put option contracts, then selling an X amount of slightly less out-of-the-money put option contracts, then selling an X amount of out-of-the-money call option contracts, and then finally buying an X amount of deeper out-of-the-money call option contracts. In terms of payoff, we have the exact same payoff as the long call condor and the long put condor. The difference is that in the iron condor, the strategy is built using a combination of out-of-the-money call and put option contracts. It's a bet against volatility with limited risk and limited reward, and the trader wants the underlying price to remain within the inner strikes in order to maximize the payoff. The short call butterfly strategy consists in selling an X amount of in-the-money call option contracts, buying 2x amount of at-the-money call option contracts, and selling an X amount of out-of-the-money call option contracts. In terms of payoff, this is the inverse of the long call butterfly. The strategy becomes profitable if price moves away from the at-the-money strike in any direction, which is exactly the opposite of how a long call butterfly works. In terms of risk, the maximum potential loss tends to be larger than the maximum potential reward, but all that needs to happen for a maximum profit is price moving away from the range of price determined by the outer strikes in either direction. The worst thing that can happen is price not moving at all from the at-the-money strike. This is a bet on volatility, but with limited reward and a maximum risk that tends to be larger than the maximum reward, so this is a moderate risk strategy. The short put butterfly is exactly the same strategy as the short call butterfly, but instead of call option contracts, the strategy is built using put option contracts, so it consists in selling an X amount of out-of-the-money put option contracts, buying 2X amount of at-the-money put option contracts, and selling an X amount of in-the-money put option contracts. In terms of payoff, this is the inverse of the long put butterfly. The strategy becomes profitable if price moves away from the at-the-money strike in any direction, which is exactly the opposite of how a long put butterfly works. In terms of risk, the maximum potential loss tends to be larger than the maximum potential reward, but all that needs to happen for a maximum profit is price moving away from the range of price determined by the outer strikes in either direction. The worst thing that can happen is price not moving at all from the at-the-money strike. This is a bet on volatility, but with limited reward and a maximum risk that tends to be larger than the maximum reward, so this is a moderate risk strategy. Next in line, we have a strategy called the reverse iron butterfly, which is the mirror image of the iron butterfly. It involves selling X number of out-of-the-money put option contracts, buying an X number of at-the-money put option contracts, buying an X number of at-the-money call option contracts, and selling an X number of out-of-the-money call option contracts. In terms of payoff, the reverse iron butterfly provides a maximum reward if the underlying goes above the out-of-the-money call or below the out-of-the-money put. The maximum risk is at the at-the-money strike price. In terms of risk, the reverse iron butterfly is a bet on volatility with limited risk and a limited reward, so it's a moderate risk strategy. The next strategy we're going to study is called short call condor, and it's the mirror image of the long call condor, so it consists in selling an X number of in-the-money call option contracts, buying an X number of slightly less in-the-money call option contracts, buying X number of out-of-the-money call option contracts, and selling X number of deeper out-of-the-money call option contracts. In terms of payoff, we have the long call condor upside down, which means that this is a bet on market volatility. In other words, the trader wants the underlying price to go above the strike price of the most out-of-the-money call option or below the strike price of the most in-the-money call option. The short call condor is a bet on market volatility with limited risk and limited reward, so it's considered to be a moderate risk strategy. The short put condor is exactly the same strategy as the short call condor, but it's entirely done using put option contracts. So it consists in selling X number of out-of-the-money put option contracts, buying X number of slightly less out-of-the-money put option contracts, buying X number of in-the-money put option contracts, and selling X number of deeper in-the-money put option contracts. In terms of payoff, we have the long put condor upside down, which means that this is a bet on market volatility. In other words, the trader wants the underlying price to go above the strike price of the most in-the-money put option or below the strike price of the most out-of-the-money put option. In terms of risk, this is a bet on market volatility with limited risk and limited reward, so it's a moderate risk strategy. To finalize the butterflies and condors, we have a strategy called reverse iron condor, which also has the same payoff as the short call condor and the short put condor, but the reverse iron condor uses a combination of calls and puts to build the final payoff. The strategy consists in selling an X amount of out-of-the-money put option contracts, buying an X number of slightly less out-of-the-money put option contracts, buying an X number of out-of-the-money call option contracts, and selling an X number of deeper out-of-the-money call option contracts. This is once again a bet on market volatility. For the trader to achieve the maximum reward, the underlying stock price must go above the strike price of the most out-of-the-money call option or below the strike price of the most out-of-the-money put option. In terms of risk, this is a bet on market volatility with limited risk and limited reward, so it's a moderate risk strategy. Let's now move on to the next set of strategies that contain the vertical spreads, the ladders, and the ratio spreads. The bull call spread strategy consists in buying an X number of in-the-money call option contracts and selling an X number of out-of-the-money call option contracts. If the underlying price rises above the out-of-the-money strike at expiration, the reward reaches its maximum value no matter how much the underlying rises. If the underlying falls below the in-the-money strike, the loss is limited no matter how much the underlying falls below the in-the-money strike. In terms of payoff, the bull call spread provides a limited maximum reward and a limited maximum risk. The ideal market scenario for this strategy is a bullish market where price breaks out of a range to the upside. In terms of risk, the reward and risk are both limited and roughly the same size. Because of that, this is a moderate risk strategy. Next on the line, we have a strategy called bear put spread, which consists in selling an X number of out-of-the-money put option contracts and buying an X number of in-the-money put option contracts. In terms of payoff, this is similar to the bull call spread with the exception that the strategy is built using put options and it's a bearish strategy, meaning that it becomes maximally profitable if the underlying price goes below the out-of-the-money put strike. In terms of risk and reward, both are limited and roughly equal to each other, so the bear put spread provides a reward to risk ratio of around 1. This is, like the bull call spread, a moderate risk strategy. Next we have the bear call spread, which is exactly the same strategy as the bear put spread in terms of payoff, but the difference is that the strategy is built using call options instead of put options. It consists in selling an X number of in-the-money call option contracts and buying an X number of out-of-the-money call option contracts. This is a bearish strategy, so the trader hopes that the underlying stock price goes below the in-the-money call strike at expiration to maximize the reward. This is a moderate risk strategy due to the fact that risk and reward are roughly the same and limited. Rather intuitively, we also have a strategy called bull put spread, which is exactly the same as a bull call spread in terms of payoff, but it's built using put option contracts instead of call option contracts. It consists in buying an X number of out-of-the-money put option contracts and selling an X number of in-the-money put option contracts. It's a bull spread, so it's a bullish strategy that maximizes its reward capacity if the underlying price is above the in-the-money put strike at expiration. This is a moderate risk strategy due to the fact that risk and reward are roughly the same and limited. The first ladder strategy is called bull call ladder, and it consists in buying an X number of in-the-money call option contracts, selling an X number of at-the-money call option contracts, and selling X number of out-of-the-money call option contracts. In terms of payoff, this strategy produces the maximum reward if the underlying price remains within the at-the-money and out-of-the-money strikes at expiration. One particular detail about this ladder is that it protects the trader if the underlying price falls too much, but it doesn't protect the trader if price rises too much. In other words, the bull call ladder is a slightly bullish strategy that assumes price will rise a little bit and stay within the range given by the at-the-money and out-of-the-money strikes. But if price begins to rise more than that, the payoff starts to dissipate. On the other hand, if price begins to fall below the range given by the at-the-money and out-of-the-money strikes, the risk is limited. In terms of risk, this is a dangerous strategy because there is a limited maximum reward and an infinite maximum risk. Beyond that, it is a bet against market volatility. Next, we have a strategy called bull put ladder, which consists in buying an X number of out-of-the-money put option contracts, buying an X number of at-the-money put option contracts, and selling an X number of in-the-money put option contracts. Even though the strategy is named bull put ladder, this is a strategy that benefits if the underlying falls as much as possible. The strategy can also produce results if the underlying rises above the in-the-money strike, but this reward is limited. This is a strategy that bets on market volatility with a bias to the downside. The maximum risk occurs if the underlying stays within the range determined by the out-of-the-money and at-the-money strikes. Even though the strategy benefits from a sharp fall in the underlying price at expiration, It's named bull put ladder because the strategy consists in buying two different types of put option contracts and selling another. The strategy maximizes its reward with a sharp fall in the underlying asset, even though it can profit for the upside as well. The maximum potential reward tends to be much higher than the maximum potential loss, and this strategy is a bet on market volatility, and therefore it's a strategy with safer risk. The bear call ladder strategy consists in selling an X number of in-the-money call option contracts, buying an X number of at-the-money call option contracts, and buying an X number of out-of-the-money call option contracts. This is a strategy that bets on volatility with a bias to the upside, meaning that the strategy wins if the underlying rises or falls sharply, but the payoff for the fall is limited, while the payoff for the rise is attached to how much the underlying rises. The maximum risk occurs when the underlying stays within the range determined by the at-the-money and out-of-the-money strikes. In terms of risk, this strategy has a limited risk with a bet on market volatility, so it's a safer strategy. Next we have the last ladder, which is called bear put ladder. This strategy consists in selling an X number of out-of-the-money put option contracts, selling an X number of at-the-money put option contracts, and buying an X number of in-the-money put option contracts. This is a strategy that maximizes its reward if the underlying price stays within the out-of-the-money and at-the-money strikes, so in a sense, it's a bet against market volatility. However, if price escapes this range to the upside, the risk is limited, and if price escapes the range to the downside, the risk is attached to how much the underlying price falls. In other words, this is a bet against market volatility, but if there is a chance that the market explodes to the upside, the strategy provides a limit for the risk. In terms of risk, this is a bet against volatility with limited max reward and a large and limited maximum risk that is much higher than the maximum reward, so it's a dangerous strategy. Next in line, we have a strategy called strip, which consists in buying 2x number of at-the-money put option contracts and buying X number of at-the-money call option contracts. In terms of payoff, the strip is very similar to a long straddle, but the difference is that the strip is slightly asymmetrical. In other words, the strategy profits in both sides, but the profit if price falls accelerates faster than the profit if price rises. We can notice that by observing how the payoff line to the downside has a steeper angle than the payoff line to the upside. The ideal market scenario for this strategy is a bet on volatility for either side of the market, but with a slight bias to the downside, since profits will accelerate faster in that case. In terms of risk, this strategy has a limited maximum risk and an infinite maximum potential reward. This strategy, like the long straddle, is considered to be a safer strategy. The strap is similar to the strip, so it consists in buying 2x number of at-the-money call option contracts and buying X number of at-the-money put option contracts. In terms of payoff, the strap is very similar to a straddle, but the difference is that the strap is slightly asymmetrical. In other words, the strategy profits in both sides, but the profit if price rises accelerates faster than the profit if price falls. We can notice that by observing how the payoff line to the upside has a steeper angle than the payoff line to the downside. The ideal market scenario for this strategy is a bet on volatility for either side of the market, but with a slight bullish bias, since profits will accelerate faster in that case. In terms of risk, this strategy has a limited maximum risk and an infinite maximum potential reward, so it's a safer strategy. The cover short straddle strategy involves buying 100x number of shares of the underlying asset, selling an X number of at-the-money put option contracts, and selling an X number of at-the-money call option contracts. This works like a short straddle, but with the exception that one of the sides provides a fixed positive payoff due to the purchase of the underlying shares. This is a strategy that works when the market is bullish, and it doesn't matter how much the underlying price rises above the at-the-money strikes as the payoff is fixed. However, losses are proportional to how much the underlying falls. In terms of risk, this strategy provides a limited maximum potential reward and a very large maximum potential risk, so it's considered to be a high-risk strategy. A similar strategy to the covered short straddle is the covered short strangle, which consists in buying 100x shares of the underlying asset, selling an X number of out-of-the-money put option contracts, and selling an X number of out-of-the-money call option contracts. The different strikes create two inflection points, unlike the covered short straddle, which only has one inflection point. The ideal market scenario and the risk structure is similar to the covered short straddle. We want the underlying to rise above the out-of-the-money call strike to maximize the reward. The maximum potential reward is small and limited compared to the maximum potential loss. In terms of risk, this is a high-risk strategy due to the large potential loss and small limited reward. Next, we have a strategy called ratio call backspread, which involves selling an X number of in-the-money call option contracts and buying 2X number of out-of-the-money call option contracts. In terms of payoff, this strategy maximizes its reward when the underlying rises as much as possible. The ratio call backspread is a bet on volatility to the upside. We can see that if there is volatility to the downside, the payoff will pretty much break even. If price stays roughly the same, the strategy generates a loss. In terms of risk, the strategy has a small maximum potential loss that is limited and an infinite maximum potential reward. Since this is a bet on volatility with unlimited potential reward and limited risk, the ratio call backspread is considered to be a safer strategy. We also have the mirror image of the ratio call backspread, which is called ratio put backspread. It consists in buying 2X number of out-of-the-money put option contracts and selling an X number of in-the-money put option contracts. This is a bet on bearish volatility with a protection against bullish volatility. In terms of risk, the strategy provides a limited risk that is small compared to the maximum reward, which is large but not infinite, since there is a limit to how much the stock price can fall. Because this is a bet on volatility with limited risk, the ratio put backspread is a safer strategy. The next strategy in line is the ratio call spread, which consists in buying an X number of in-the-money call option contracts and selling 2X number of out-of-the-money call option contracts. In terms of payoff, the strategy limits the risk below the in-the-money strike, maximizes the profit at the out-of-the-money strike, and maximizes the loss as the underlying price rises above the out-of-the-money strike. The ideal market scenario is that the underlying remains near the initial out-of-the-money strike, so this strategy is a bet against market volatility. However, if price falls, the strategy provides a risk limit, which doesn't happen if the underlying rises too much. In terms of risk, this is a bet against market volatility with limited reward and infinite risk, so it's a high-risk strategy. The ratio put spread is the mirror image of the ratio call spread. The strategy is built by selling 2X number of out-of-the-money put option contracts and buying an X number of in-the-money put option contracts. In terms of payoff, the profit is maximized at the out-of-the-money strike, so it's a bet against volatility with a protection if price rises too much. However, there is no protection if price falls too much. In terms of risk, this is a bet against volatility with limited reward and large risk, so it's a high-risk strategy. Next, we have a strategy called collar, which involves buying 100x shares of the underlying asset, buying an X number of out-of-the-money put option contracts, and selling an X number of out-of-the-money call option contracts. In terms of payoff, the collar maximizes and limits the profit if the underlying rises above the out-of-the-money call strike, and maximizes and limits the loss if the underlying falls below the out-of-the-money put strike, so it's a bullish strategy with a limited risk. In terms of risk, this is a bet on bullish volatility with limited risk and limited reward, so it's a moderate risk strategy. Now we'll move on to the last category of strategies, which are the synthetic option strategies and a few others. The synthetic call strategy is a way to simulate the payoff of a call option using the underlying in a put option, so it consists in buying 100x shares of the underlying asset and buying an X number of at-the-money put option contracts. This combination will form the same payoff of a call option, so there is a limited risk if the underlying falls below the at-the-money strike, and an infinite maximum potential reward if the underlying rises above the at-the-money strike. In terms of risk, the synthetic call is exactly the same as a long call, with a limited risk and an infinite potential reward, so it's considered to be a safer strategy. Next, we have the synthetic put, which simulates the payoff of a long put strategy using the underlying in a call option contract. This strategy is built by selling 100x shares of the underlying asset and buying an X number of call option contracts. In terms of payoff, the strategy profits as price falls below the at-the-money strike, and the risk is limited if price rises above the at-the-money strike. In terms of risk, this is exactly the same as a long put strategy. There is a limited risk and a limited reward that is potentially much larger than the risk. This is in some sense a bet on bearish volatility with limited risk, so it's a safer strategy. We can also simulate the payoff of buying the underlying asset by using a combination of calls and puts. This strategy involves selling an X number of at-the-money put option contracts and buying an X number of at-the-money call option contracts. The payoff is simply an upsloping straight line, which is the payoff obtained from buying the underlying asset. The risk is also the same as buying the underlying asset. There is a limited and large risk if the underlying falls, and an infinite maximum potential reward if the underlying rises. This is of course a bet on bullish volatility, but this is not an option strategy per se. This is just one way of simulating the payoff of the underlying asset using only option contracts. There is also the possibility of simulating the payoff of shorting the underlying stock. To do that, the trader needs to buy an X number of at-the-money put option contracts and sell an X number of at-the-money call option contracts. The resulting payoff is a downsloping straight line, which is the payoff of shorting the underlying stock. In terms of risk, the synthetic short stock provides a limited maximum potential reward since the stock cannot fall more than zero, and an infinite potential risk as the underlying can rise indefinitely. This is of course a bet on bearish volatility, but this is not an option strategy per se. This is just one way of simulating the payoff of the underlying asset using only option contracts. There is also the possibility of simulating the payoff of a long straddle without using put options. The synthetic long straddle is formed by selling 100x number of underlying stock shares and buying 2x number of at-the-money call option contracts. The payoff is exactly the same as a long straddle, but the synthetic long straddle is formed by combining the underlying stock and call option contracts instead of a combination of calls and puts. The synthetic long straddle is a strategy that profits from volatility, so the trader wants the underlying to move away from the at-the-money strike as much as possible for either side of the market. In terms of risk, the synthetic long straddle provides a limited risk and an infinite potential reward, so it's considered to be a safer strategy. We can also form a synthetic long straddle using a combination of the underlying and put option contracts. That involves buying 100x shares of the underlying asset and buying 2x number of at-the-money put option contracts. The synthetic long straddle is a strategy that profits from volatility, so the trader wants the underlying to move away from the at-the-money strike as much as possible for either side of the market. In terms of risk, the synthetic long straddle provides a limited risk and an infinite potential reward, so it's considered to be a safer strategy. Just like we can form a synthetic long straddle using a combination of the underlying and call option contracts, we can do the same with a short straddle. The short straddle with calls is formed by buying 100x shares of the underlying asset and selling 2x number of at-the-money call option contracts. The payoff of a synthetic short straddle with calls is exactly the same as a short straddle. It's a bet against volatility with infinite risk and limited reward, so it's a high-risk strategy. The short straddle with puts is formed by selling 100x shares of the underlying asset and selling 2x number of at-the-money put option contracts. The payoff of a synthetic short straddle with puts is exactly the same as a short straddle. It's a bet against volatility with infinite risk and limited reward, so it's a high-risk strategy. The next strategy we are going to analyze is called long combo, and it consists in selling an X number of out-of-the-money put option contracts and buying an X number of out-of-the-money call option contracts. In terms of payoff, the long combo mitigates the risk if the underlying remains within the range determined by the out-of-the-money strikes. If the underlying falls below the out-of-the-money put strike, the risk is limited but very large. And if the underlying rises above the out-of-the-money call strike, the reward is infinite. This is a strategy that bets on bullish volatility, but with large risk for the downside, so it's a high risk strategy. The last strategy we are going to analyze is called short combo, and it consists in buying an X number of out-of-the-money put option contracts and selling an X number of out-of-the-money call option contracts. In terms of payoff, the short combo mitigates the risk if the underlying remains within the range determined by the out-of-the-money strikes. If the underlying falls below the out-of-the-money put strike, the reward is limited but very large. If the underlying rises above the out-of-the-money call strike, the risk is infinite. This is a strategy that bets on bearish volatility, but with infinite risk for the upside, so it's a high-risk strategy. So far, we have seen the payoff and properties of these strategies, assuming they will be carried to expiration of the options involved. However, as I said earlier, carrying the options to expiration is not a necessity. You can apply these strategies and negotiate the options before their expiration. The problem with that is that you need to be aware of a few more advanced ideas that impact the price of options before they hit expiration. Beyond that, these simple strategies we just saw are not the way that institutional traders like bank traders negotiate the derivatives market. Institutional traders apply different techniques that are associated with the concepts that we are going to introduce in the third and final part of this course. In this third part, I'm going to give you only a brief introduction to the more advanced ideas that will enable you to understand real institutional trading with options. The strategies we study in this beginner's guide are mainly used by retail options traders. Institutional options traders use these instruments in a completely different way, and there are scientific reasons for that. The first reason is that these strategies we just learned are speculative, meaning that a lot of them are based on what direction the underlying price will take or where it will be at expiration. This is speculative in nature because the trader needs to conjecture about the future direction of the underlying price. The issue with speculation about price direction is that there is a significant degree of uncertainty built into it. Nobody really knows what's going to happen with price because it behaves in something called Brownian motion. Traders can only speculate about the future direction of price. There is a significant risk associated with that. In fact, this is precisely why the derivatives market exists in the first place. Derivatives, like options, are not meant to be an instrument of speculation. They're supposed to be an instrument used for protection against the uncertainty of speculation. Another way of looking at this is that the derivatives market, like the options market, is meant to be used for hedging or arbitraging, and not for speculation like most of the retail options traders think. This leads us to the second reason institutional traders don't use options for speculation. The derivatives market, more specifically the options market, allows institutional players to trade price volatility instead of trading price direction, and that has tremendous consequences. The reason why they do that is that price volatility is much easier to predict than price direction. Without getting too much into the specifics, the price of a financial asset is known to be the most difficult type of financial time series to predict because it has very complicated properties. Properties like being stochastic, meaning that the price of a financial asset is subjected to random shocks, being non-stationary, meaning that the price of a financial time series has variable mean and variable standard deviation, and the fact that the price of a financial asset is also heteroscedastic, meaning that its variance varies across time. These properties make the effort of predicting the future price of a financial asset a very difficult task. Price volatility, on the other hand, has much easier properties to deal with that enable traders to negotiate it more easily. That's why institutional traders focus on that instead of price direction. However, in order to trade price volatility, the option trader needs to be aware of a few more advanced ideas regarding the options market. The trader needs to understand about option pricing models, implied volatility, and what's called option Greeks. Let's first discuss a little bit what an option pricing model is and how it is used. An option pricing model is nothing more than a mathematical formula that returns the fair price of an option. In other words, it's a mathematical formula that incorporates all the variables that affect the price of an option and organizes them. In the case of European options, the most famous option pricing model is called the black-scholes model, which rendered a Nobel Prize in 1997 for its developers. The black-scholes model takes variables like volatility, underlying price, strike price, time until expiration, and the risk-free interest rate to return the fair price of a European stock option. The idea that a mathematical formula will return the fair price of an option seems interesting because we can use the formula to know if the option is overvalued or undervalued, but that's not what happens in reality. The actual price of an option is determined by the forces of supply and demand in the market. So the black-scholes formula is actually used to find the implied volatility of an option and the option Greeks based on the option prices given by the natural supply and demand mechanism of the market. The implied volatility and the option Greeks are what institutional options traders use to trade price volatility instead of price direction. The implied volatility is extracted out of the black-scholes model. The option Greeks are the partial derivatives of the black-scholes model, and each of the Greeks show a different type of risk associated with an options position. This is just a beginner's guide, so I'm not going to go into detail about these ideas. I'm just sparking your curiosity for the moment. If you want to go deeper into the black-scholes model, check out one of my videos called The Black-Scholes Model Explained in the YouTube card. Trading volatility is more interesting than trading price direction because of something called antifragility, which is an idea proposed by Nicholas Nassim Taleb. When you think about something fragile, you think of something that is very vulnerable to chaos. For example, a wooden house in the middle of a hurricane is very fragile. When you think about the opposite of fragility, you think about robustness. For example, a bunker in the middle of a hurricane is robust because it can survive the hurricane. However, robustness is not the opposite of fragility. Robustness dwells in the middle of the antifragility spectrum. The opposite of fragility is antifragility, which is when something thrives with chaos. Something robust only survives chaos. Volatility traders are anti-fragile because they make money when there is chaos. Traders who trade price direction, on the other hand, are at best robust, and for the most part, they are fragile because when there is too much volatility, they are more susceptible to lose money. Volatility traders, on the other hand, are benefited when chaos hits the market. It's much easier to rely on chaos than it is to rely on the absence of chaos. That's why volatility traders have an edge over directional traders. That's why institutional traders like bank traders negotiate volatility through the derivatives market. Learning institutional trading has several advantages. Like I said previously, one of the major advantages is that derivatives in the way that institutional traders operate are anti-fragile, meaning that you can profit when chaos hits the market. If you take a look at the news on a daily basis, you'll quickly realize that making money out of chaos is an incredibly interesting idea because the market is hardly ever free from chaos. There is always some serious political or economic news shocking the market. The other advantage is that institutional trader is actually easier to apply than certain price action methodologies, for example, because they are almost 100% mechanical and they deal with price volatility, which is much easier to deal with than price direction. There's a bit of a paradox in here because trading methodology that is easy to learn tends to be difficult to apply, and a methodology that is more difficult to learn tends to be easier to apply. That's the case with institutional trading. It's a little bit more difficult to learn due to the necessity of learning certain mathematical concepts, but in terms of application, it's much easier than a subjective price action analysis, which involves quite a bit of uncertainty. A third advantage is that institutional trading is actually backed up by hard science. Many of the strategies involving stock options in the institutional paradigm involve several Nobel Prize winning ideas, which is the highest award in science. So these strategies are the best that science has to say about how to make money in the markets. Another very interesting advantage is that by trading volatility, you can make money regardless of price direction, which is a huge relief to traders who are used to speculate about future price direction. If you want to learn a few of the most powerful institutional trading strategies for stock options, I wrote 3 ebooks outlining such strategies. One of the advantages of these ebooks is that they use a more accessible language, unlike most of the academic books that cover derivatives. All 3 strategies have a common backbone, but each strategy explores a different way of using stock options to gain from chaos in the markets. If you want to learn more about the table of contents of each strategy, you can visit my official website fractalflowpro.com in the link available in the video description. That's it for this video. I hope you learned something new and useful. If you enjoy the material I create, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.